Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Univest Financial Corporation Annual Report. Univest Financial Corporation offers a wide range of financial services through its three main segments: banking, wealth management, and insurance. The banking segment provides various banking services to individuals, businesses, municipalities, and nonprofit organizations. These services include deposit taking, loan origination and servicing, mortgage banking, equipment lease financing, and other general banking services. In addition to banking services, the company's wealth management segment offers investment advisory, financial planning, trust, and brokerage services for private families and individuals, as well as municipal pension plans, retirement plans, trusts, and guardianships. The insurance segment provides full-service insurance brokerage agency services, including commercial property and casualty insurance, employee benefit solutions, personal insurance lines, and human resources consulting services. The recent surge in Univest Financial Corp's UVSB stock price can be attributed to several key factors that have contributed to its notable increase over the past year. One major driver has been the company's strong financial performance, particularly in its fourth quarter of 2025. In January and February 2026, Univest reported robust earnings per share, EPS, of $0.79, exceeding analysts' expectations and leading Keefe, Bruyette & Woods to raise its price target for the company. Another significant factor has been the expansion of Univest's share repurchase program in December 2025. The company increased its authorization by 2 million shares, representing 7.1% of its common stock outstanding as of November 30, 2025. This move demonstrated the company's commitment to returning value to shareholders and continued active capital management. The positive third-quarter results in October 2025 also played a crucial role in boosting Univest's stock price. The company reported a 38% year-over-year increase in its Q3 2025 net income, with management projecting further growth in net interest income. While the first two quarters of 2025 showed year-over-year increases in net income and EPS, they did not individually exceed the 20.17% stock price increase threshold. Overall, Univest's strong financial performance, strategic capital management, and commitment to returning value to shareholders have all contributed to its significant stock price appreciation over the past year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. Common drivers across multiple pages include interest rates and inflation, loan originations and prepayments on loans, sale of loans or other assets, changes in market interest rates, credit losses relating to investment portfolio, liquidity for resales of certain investment securities, and reliable pricing information for investment securities. Industry-specific drivers also play a significant role. For instance, the wealth management business is heavily influenced by assets under management, AUM, changes in tax law and public expenditures affecting industries and markets involved, regulatory policies and compliance costs, residential mortgage-backed securities, and corporate bonds. Segment-specific drivers further break down the revenue growth or decline within specific segments of the company. In the banking segment, interest income and non-interest income are key drivers, while in the wealth management segment, investment advisory commission and fee income, as well as trust fee income, drive revenue. The insurance segment is driven by insurance commission and fee income. Other drivers that contribute to revenue growth or decline include acquisition activities, operating results, dividends from subsidiaries, ability of subsidiaries to pay dividends, and macroeconomic factors such as prepayment rates, curtailment rates, unemployment rates, GDP rates, and house price index. The net income of the company experienced fluctuations between 2021 and 2025. Initially, it decreased by 16% from 2021 to 2022 due to various factors such as an inverted yield curve and rapid changes in market interest rates that affected net interest income. However, it increased by 13% from 2023 to 2024, before decreasing by 1% from 2024 to 2025. Despite the fluctuations in net income, profit margins showed a more consistent trend. The return on average assets decreased from 1.38% in 2021 to 1.12% in 2022, but increased from 0.96% in 2024 to 1.11% in 2025. Similarly, the return on average equity decreased from 12.5% in 2021 to 10.13% in 2022, before increasing from 8.85% in 2024 to 9.9% in 2025. The reasons for these changes are multifaceted and include factors such as regulatory policies, increased costs of compliance, and potential disruptions from acquisitions. Additionally, the company faced challenges related to credit losses on commercial business, real estate, and construction loans, which affected profit margins. Overall, the net income and profit margins of the company were influenced by a combination of external and internal factors that impacted its financial performance over the period. The company's financial performance indicates a positive trend in its operating cash flow. In the years 2023, 2024, and 2025, the company has generated significant amounts of operating cash flow, with figures reaching $89,741, $75,106, and $101,512 respectively. This is also reflected in the net cash provided by operating activities, which stood at $12,002, $53,785, and $94,511 for the same years. These numbers demonstrate a consistent increase in the company's ability to generate positive operating cash flow, indicating a strong financial position. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt level, there has been a mixed trend. On one hand, total liabilities increased by $252.5 million from 2024 to 2025, indicating an overall increase in debt. However, total debt decreased from $7,148,483 in 2024 to $7,144,701 in 2025, showing a slight decrease of $3,782. Regarding interest expenses, the trend is more consistent. Interest expenses have generally increased over time, with a notable plus 32.6% increase from 2023 to 2024, and a further increase by $49,452 from 2023 to 2024. However, in 2025, interest expenses decreased by $10.9 million from 2024, indicating some stability. Overall, while the company's debt level has seen some fluctuations, its interest expenses have generally increased over time, with a slight decrease in 2025. Management's outlook on the company's strategy and future prospects can be summarized into several key points. Firstly, management prioritizes employee well-being and retention through various initiatives such as training programs, mentorship, and benefits. They aim to create an inclusive work environment that encourages employee participation and contributions to the community. This suggests a focus on building a strong and engaged workforce, which is essential for long-term success. In terms of strategy, management emphasizes creating a culture of inclusivity and diversity through employee engagement initiatives. They also highlight the importance of investing in information technology systems and cybersecurity measures to prevent system failures, interruptions, or breaches. This indicates a commitment to staying ahead of the curve in terms of technological advancements and protecting against potential risks. The company's financial strategy is also noteworthy. Management acknowledges that inflation remains elevated and may negatively impact the value of assets and income from investments. They are also aware of the challenges posed by attracting and retaining skilled employees, particularly AI talent. To mitigate these risks, they have implemented a third-party risk management policy to manage risks associated with vendors. In terms of financial performance, management is focused on minimizing interest rate risk and maximizing net interest income. The company uses various techniques to identify and evaluate potential risks, including gap analysis and earnings at risk simulation modeling. They are also committed to managing credit losses through their allowance for credit losses. Overall, management's outlook suggests a focus on building a strong and inclusive workforce, investing in technology and cybersecurity, and managing financial risks to ensure long-term success. The company has a history of rewarding its shareholders through various means. One such way is by paying out dividends, which it has done consistently. In fact, the company has paid out significant amounts in cash dividends, with the most recent payout being $25 million. In addition to paying out dividends, the company has also been actively buying back shares from the market. This strategic move not only boosts shareholder value, but also reduces the number of outstanding shares, thereby increasing earnings per share. The company's share buyback program has seen it purchase 479,690 shares at an average price of $32.14 per share. There are growing concerns among businesses and economists regarding potential disruptions to global supply chains. One of the primary worries is the accumulation of inventory due to increased demand and production levels. This buildup can lead to storage costs, reduced efficiency, and decreased competitiveness in the market. Supply chain disruption is another pressing concern, as it can have far-reaching consequences for companies and economies alike. Disruptions can be caused by various factors such as natural disasters, trade wars, or logistical issues. When supply chains are disrupted, businesses may struggle to meet customer demands, leading to lost sales and revenue. That concludes the financial summary for Univest Financial Corporation. Feel free to comment below, and I will be happy to answer them when possible.